All right, we're having an internet issue apparently, but I'm going to go on. If I'm broken up, hopefully the panelists, when they speak, they're more important. You'll hear them. So I'm going to start with introducing everyone. My name is John Palmberg. I'm a shareholder at Becker. I'm going to be moderating this talk. We're going through a series of information that relates to what's going on in finance and how that relates to the legal world. The first, I'm going to introduce them based on how I'm going to start off the questioning. So it's sort of like in order of appearance. I'm going to start off by introducing national finance experience. He's a senior executive in charge of all credit and risk activities, and he oversees all operations across all business units. Tony has experience with turnarounds, restructuring, serving as a CEO. Tony also has served in the past as a managing director for CBIZ and PricewaterhouseCoopers. Before that, he was a director at KPMG. The City National Bank, and he's with private banking. He started with City National in 2013, and in 2019 he started serving City National as a private group director, and he oversees a total book of business of $1.5 billion in deposits and loans. He focuses his practice on commercial and financial transactions. He is litigated to defend creditors' rights or pursue creditors' remedies. Paul has represented a broad array of clients, including in matters like secured lending, asset-based lending, commercial finance, debt restructuring, sales and lease transactions, negotiable instruments, letters of credit, yada, yada, yada. Sorry, Paul. As a principal with HIG, he's been responsible for all aspects of the investment process, sourcing, transactions, and John serves in his capacity with HIG. He also serves on several boards for portfolio companies in the HIG. Rob Palmberg, as you can tell, has the same last name as me, so he has agreed to sit on this, but he also suffers having to serve as my brother. So with carrying that weight, he is the head of data for leverage finance at Fitch Solutions. He joined Fitch in 2018 when Fitch acquired from Fulcrum Financial Data LLC, LevFin Insights Inc. LevFin he'll explain exactly what that is because I'm not exactly sure what he does other than analyze a lot of stuff that I have trouble understanding. He was a principal and managing director at LevFin Insights. Rob also was the managing director of research and data analytics at Leverage Commentary and Data, which was a Standard & Poor's company. James is the chairman of Cassell and Saltpeter. He's also the founder, and he serves as an investment banker. He not only is an investment banker, but he does so as a lawyer. He focuses on representing middle market companies and has negotiated, structured, and executed transactions ranging from mergers, acquisitions, divestitures, corporate and transactional financings, and public offerings for domestic and global companies. And last but certainly not least is another colleague of mine, Rob Breitner. Rob Brighton, he's a shareholder at Becker, and he is a transactional lawyer involved in corporate. He focuses on securities, corporate finance, mergers, acquisitions, and divestitures, private equity, and venture capital. Interesting, Rob and I also both serve on the business law section of the Florida Bar, and in that role, Rob has been involved with amending, with many legislative initiatives, including amending the Florida Business Corporate Act and the Limited Liability Companies Act. So, if I were to spend the rest of the time going through these people's bios, there'd be no time for us to discuss anything substantive. So I apologize to the panelists for cutting their bio short, but I wanted to get down to business and start discussing what's important. So as promised, Tony, I'm going to you first, so please be ready. In your role at Global, how is the global portfolio performed during the COVID-19 crisis?
Thanks, John. I think on balance, things have gone very well for us. In fact, they've gone surprisingly well. We've really not had any major surprises. We have seen, obviously, our funds employed, net funds employed, have dropped a bit, but they were actually up in the month of April. And to date, we're only really down by about 15 or 20%. We think that the industry is probably twice that. So, as we drill down through things, what we're finding is that the majority of our portfolio was invested heavily into what we call the last mile delivery distribution on the trucking side. So you couple that with the fact that another 7.5% of our portfolio was very well connected to the food industry, and you could see that about 60% of our book is by definition essential business. So we've been able to stay pretty solid in terms of performance. What's really interesting through all this so far has just been the utilization. When we first started this back in February, what we did is we measured, we do this every month, we measure the amount of outstanding loans in comparison to the available collateral, eligible collateral by definition that's up and down our portfolio. And when we started this, it was running about 70%, which implies that our clients have got about a 30% cushion in their borrowing base. But as of last Friday, that percentage had actually gotten better. It's now 60%, which means that on balance, our clients have got 10% more availability under their credit lines than they had before this crisis started. So, some of that's just kind of luck. We deployed a pretty rigid communication structure. We put it in place very early in this process. We talk to our clients at least once a week, if not every day. We're obtaining feedback. And I think at the end, just talking to people has really helped our situation. So we've been pleasantly surprised so far.
Thanks, Tony. Ricardo, I want to go to you. Sort of the same question, but also tell us how deferments are working as you're answering that question about how the assets that you're monitoring are performing.
So, from a City National perspective and a commercial bank perspective, the first request for deferment was handled by looking at the underlying asset and really finding if they're in the affected category. So when we look at the hotel industry, the restaurant industry, and those offices, some multifamily properties as well, commercial strip centers that were really affected early on with folks not paying rent or not being able to really work and produce the cash flow that's needed to service the debt, we felt that the first sort of 90-day deferment was good to go. What we're finding is that you do get some mixture in there. We have a diversified portfolio here at City National, so luckily we've been able to weather it good as an institution. But you get some of those folks that are just asking to ask. So from a first 90-day process, we were a lot more lenient in the request. What we're really focusing now as an institution is communicating with our clients, seeing how they're doing, getting out in front of the time frame where that original 90-day deferment is going to mature, and seeing what that second 90-day deferment looks like if a deferment is going to be granted. We want to make sure that we are helping the community where it really needs to, but making sure that our book of business is really protected going in. So any second deferments that people have already started to discuss with the bank are being looked at a little bit more rigorously to ensure that we're protected, and that's really required.
So, Ricardo, overall, in addition to the deferments, and we're only talking about commercial paper, how is the portfolio performing for the private banking group?
So we've been pleasantly surprised on our side. I think that in the private banking side specifically, we have really good clientele that even on some of the business side, we deal a lot with doctors, attorneys. They've been able to weather the storm. capture that with the PPP process that was sort of the SBA kind of put on us. We've been able to do very, very, very good. Our portfolio has performed very nicely, and we continue to monitor it, but so far so good.
So, Paul, given the information you just heard and maybe some particular communications and materials you've read, what are you seeing as far as how the loan documents are being addressed given the crisis, and how are you dealing with the COVID-19 crisis for your lender clients?
Well, John, I gave some thought to this, consulting with my sidekick over here, Sparky, and it's an interesting question given the answers that you just got, because as a lender's lawyer during these times, I think the big issue for the attendees to think about is that oftentimes the standard loan agreement doesn't really deal with what happens when you have a virus. And we don't have a force majeure clause in loan agreements. If you read a promissory note, it says that the borrower has an unconditional obligation to pay. And in the loan agreement, there are covenants that the borrower has to address. And these are the lead-ins to, if you will, the party's performance. So what I'm seeing these days as a lender's lawyer are in effect the opposite, perhaps, of what Tony and Ricardo said, because I'm being asked to prepare loan modifications and in some cases forbearance agreements for lenders because we have borrowers that are not performing, and the lender and the borrower are trying to work out some amicable adjustment to keep things moving. So it may be a covenant violation that has to be waived, or perhaps a covenant that has to be adjusted to allow the borrower to function because the borrower's suppliers and customers perhaps are not performing, and yet the borrower still has payment and performance obligations for the lender. So it raises the specter of the lender and the borrower's obligations to perform in good faith. Every loan agreement and contract has that implied obligation. And what I am seeing is an awful lot of effort by lenders to work with their borrowers, to give them opportunities to adjust the debt, to allow them to get through this crisis, whether it is in the form of a short extension or of a waiver or of a document that modifies some of the provisions. I also see the lenders focusing in on reporting and looking at the collateral perhaps a little bit more diligently. And of course, one of the issues in an asset-based loan these times is how do you monitor, how do you do a field examination of a borrower's collateral when you're lending on that? So these provide some very interesting issues for the lender, but I see the lenders working very diligently with the borrowers and avoiding more acrimonious litigation or trying to keep the borrower out of a bankruptcy.
So, John, I want to move over to you now because you represent a bunch of portfolio companies that are in all likelihood borrowers. And they're dealing with these issues from the other side of the fence. So tell me what you're seeing, in the run up to the COVID-19 versus right after all this started.
Yeah, thanks, John. And you're right, we have dozens of portfolio companies ranging across industries from food services to tech and telecom. But in general, I would certainly agree with my co-panelists here, with Paul and Ricardo most recently were saying that really no one from a borrower or a lender perspective, wants to be seen as taking advantage of the COVID situation. I think everyone is working in that good faith that Paul referenced to really get to the other side of it. And look, for us in particular, we have the good fortune, so to speak, of having some Italian offices And so we were able to see firsthand when the COVID crisis was really starting to escalate in the early days, what was coming. And so our portfolio companies were able to batten down the hatches very quickly and prepare themselves, and subsequently have been engaged in pretty active dialogue in their industries to see if there are competitors to help, where you can divide and conquer, or working with the borrowers and the lenders, I should say, as well, to work through things. In general, we are value buyers, so we don't have over-levered businesses to start with. And, in general, we are looking for consolidation opportunities. And so our companies are quite stable across the board and are really out there, we think as, hopefully lights in their industry that other companies are attracted to, yet more so as they see their resiliency in this environment.
All right, thanks, John. Now, Rob Palmberg. We have two Robs, so I'm going to have to always, Rob P and Rob B. That's not going to work. That's too close. Rob Palmberg and Rob Brighton. So, Rob, the work that you do, and how are the analyses for the debt that you're looking at in the run up to COVID-19 and then now, how do they compare?
Yeah. Well, thanks, John. Big brother. Yeah, we're sort of, we were chugging along 19 in the January and February of 20. We're pretty normal and sort of working the way we expected, and seeing lots of different transactions, repricings, refinancings, and all sorts of transactions. We were averaging, I have a horrible memory, so bear with me. We're averaging like $24 billion of bonds through 19 and 20, and around $50 billion of loans over the first couple months of this year. Yes, between COVID, since then, I break it down into 3 months, right? March, April, May. March was a shutdown, right? March, nobody knew what was happening, and basically the markets just froze solid, and you didn't see anything. April was rescue, right? Who needed money? How do we get them money? And, lots of bonds being done for general corporate purposes, liquidity, lots of revolver draws, a lot of term loan Bs that were issued just for liquidity purposes, just to put cash on the balance sheet. Nothing exciting there at all. May, we're starting to see some deals come out, some interesting deals. Now, they're coming out at a cost. I mean, we are not seeing 1920 type structures. We could take case studies of each. You could take Macy's, which obviously is a very storied credit. They did bonds, flew off the shelf, went from $1 billion of bonds to $1.3 billion of bonds in a day. Cleared quickly, traded up to 102 on the next day. I mean, just amazing blowout. But think about what they had to pay to borrow that money. It was like 8 3/8, I think, at par. That's a year ago, 2 years ago, that's an investment grade issuer probably would have never paid more than 5% on an unsecured debt. This is fully secured by their assets, by their real estate. So clearly paying a big cost. And again, Macy's might be a horrible example because it's Macy's. And it's in obviously a horrible sector, and had trouble walking into the year, forgetting about where it ended up after COVID. But if we look at even leveraged loans, a deal like Ziply, which is it's the most recent LBO to clear the market. That loan got done, and again, my memory, I know about where it got done, but I'm going to read it anyway. That loan got done at L plus 550 and 96.25 offer price. Again, not a great sector, good sponsors though, pretty good company, had a good balance sheet, only 4.5 times leverage at the time it closed with adjustments. But if you look back to February deal that cleared, again, better sector, a little bit better ratings, similar loan size, that loan cleared at 4.25, so basically, and 99 offer. So they basically paid a 125 basis point premium to clear Ziply over where they might have had to clear it 4 months ago. And again, I'm not a structure guy. I'm just an innocent bystander on this stuff. We also, at my company, one of the premier things I really like, and it's again my sister company called Covenant Review, we also look at the documentation and we score the documentation on these loans. Ziply came in at a doc score of 3, 1 being the most protective and 5 being the least protective. They came in right in the middle at 3. That same deal, Sundyne, my example, was a 4-. So clearly docs have also tightened. In fact, the average doc score right now is like 3.3 times, 3.3, not a time. A year ago, it was like just under 3.9. So clearly docs have also tightened over this period, and we don't see much of that changing anytime soon. I have other case studies here, and there's more, but the one thing I do want to present also on the loan side of things, we look at incremental loans issued as tack-ons to existing loans. Historically, that gap, that spread gap would have been about 60 basis points, so you would have paid a 60 basis point premium for the second loan. Currently in May, it's 167 basis point premium. So same issuer, same maturity, different terms, mostly the same terms, and they're issuing at 167 basis point premium to their existing tranche. So clearly the cost of capital has gone way up, much more difficult to get a loan done these days, or bonds are just flying off the shelf. I don't know, the high yield market's just been on fire. So yeah, so it's interesting times, definitely different kinds of deals. And again, we're seeing more deals come to market. And again, not just the deals that had to have rescues, but also for M&A type transactions and refinancing and bond redemptions.
All right, well, that brings me to Jimmy. So you're the person in the middle pulling all these strings together to make deals happen. So tell me what you're seeing.
It's interesting, and thank you for allowing me to participate. It was interesting if we look back at the very beginning, and we'll call the beginning March, mid-late March, as panic set in for many middle market businesses. And we work with a lot of middle market businesses, both in raising capital and in potentially selling them, both healthy and distressed. So month one was panic, and everybody was scrambling, whether it was PPP or trying to get whatever loan or liquidity they could get, not having any idea what was going on. After about 30, 45 days, we saw people starting to sort of catch their breath, but not necessarily knowing what was going on. And then it's become somewhat of a tale of two cities. Some companies that might have wanted to go to market have said, let me just get through this, see how things are, because what's happening now creates a real valuation issue. When we're talking to potential buyers, and traditionally people look at trailing 12 months EBITDA, you're going to have a gap in that trailing 12 months. And can you convince someone that it's a gap and you're going to get back to where you were? Or alternatively, is it going to be a new normal, which is going to be a lower number? So some people have tried to take a step back and just wait, hold, if they don't have to do anything, hold off. On the flip side, we're involved in a few bankruptcies that have been filed as a result or during the COVID process. And they're something that we've never really experienced is the concern as to whether there will be a buyer for some of these lower middle market assets at any price. And it's something that the lenders are starting to take note of. And it's not that they're not good assets, and the valuations that were done when the collateral or the loans were made were not done properly. It's a lot of the potential buyers are waiting, they want to hold their cash. They don't want to pick up an asset, even though it may be a great asset, depending on where their business is, and use what might be cash they need to get through the next 30, 60, 90, 120 days. So it's something in the lower middle market that we have never seen. So it's a different time. So as I said, the healthier businesses are just, treading water, looking for opportunity, but the distressed businesses are not. And they're doing what was described earlier by some of my colleagues on the panel. They're talking to the banks, and we found the banks to be very willing to work with many of the borrowers. First, the PPP helped, and now they're working with them. Some of the non-bank lenders have approached it a little differently, we're seeing. Some of them, I won't say they're more aggressive, but they're more concerned. They want to make sure they're continuing to get their yield and what have you, where the banks are taking a little bit of a step back and giving a little bit more of a breather.
Hey, Jim, if I could just interject, it's an interesting observation you make about the lack of buyers, because our experience on the lender side is often that the motivation that the borrower has to file a bankruptcy is to go through a 363 sale and find a buyer that will get the benefit of that order. So it sounds like perhaps there's a need for a re-examination of that.
I think what we're seeing is you need to have a sufficient time And I will tell you, sitting here today as we are at the end of May versus we went to, we literally were hired in mid-March to go to market. And it's been a very troublesome situation. I think today it'll be different than it was even 2 months ago. You know, just like the interest rates, if you borrowed, was just described, you know, a couple of minutes ago by Rob, if you borrowed back in early March, you're talking 100, 200, 300 basis points difference. Going to market today versus going to market 3 months ago, people are starting to feel more comfortable and knowing what they're dealing with. So I think they will react. But just getting people's attention, getting a VP finance's attention, you know, for an M&A guy saying, I want to buy this asset, he's saying, wait a minute, I want to keep our company alive. You know, I want to deal with my banks on my covenant relief. I want to see which of my customers are going to pay next month when they're supposed to pay. I want to really look at my receivables very carefully to see what's coming in. Are people extending out? I think it's interesting. So we're in a different, you know, boat, and we have this conversation in 90 days. I think it'll be very different than 90 days ago.
So Rob Brighton now. So we go to you because now you've heard all of this discussion about where the loans are, what the buyers are looking for, what the borrowers are looking at, and the whole market seems a little unsettled, but things are starting to steady. How are you seeing this manifest in your deal docs?
Before I get to that, I just want to make a brief comment on some of the comments that were made about the debt markets. You know, one of the things that we saw was that a lot of people that had availability on existing revolvers drew down those lines immediately following the onset of the crisis. But in large part, people have paid off in part or in whole those amounts largely from bond proceeds that they've been able to do after the fact. And that has to do with the need to really evidence some liquidity immediately on their balance sheet. But after things stabilized, they were able to look at a situation where they could probably get you know, more reasonable covenants and representations out of the bond market, and maybe some better pricing. But anyway, back to the M&A side. Let me start by saying we had a very robust beginning part of the first quarter in terms of the M&A market. And as certainly any of the M&A professionals on this call are aware, there was plenty of dry powder in the private equity firms, and there was a lot of appetite among the strategics, which was pushing valuations up to all-time highs, particularly in certain sectors. Arguably that was starting to top off even before the onset of COVID. I know I was getting some pushback in some of the deals that I was doing in terms of looking at the valuations even then. And I think we're probably near a top just before COVID came. In the post-COVID world, certainly, and we'll get to this in a later question, there's been some significant impact on valuations, both for deals that were already being negotiated and documented, as well as those that are prospective deals going forward. One of the things that John didn't mention in his introduction to me is that I'm also the immediate past chair of the ACG Capital Connection. So in that regard, I've had a lot of ability to talk to a lot of private equity firms and investment bankers. In fact, I had a call this morning when we were talking about this year's Capital Connection and where that was going. And the sense that I got was that the deal market is pretty much going to do the deals that are fairly far along and papered, unless there's some overwhelming concern, and kind of wait and see what happens through the second and third quarter, and really start to look harder at new deals in the fourth quarter. That's not to say there might not be some opportunistic buying opportunities prior to that, particularly in the distressed area. But I think that as a general statement, that's true. Now, what has all this meant for deal documentation? Well, there's been a lot of talk about provisions like force majeure, possibility and practicality of performance, frustration of purpose, the latter three being affirmative defenses to a default. Some of you are probably aware of the collapse of the L Stores deal. Davis Polk counsel for L Stores apparently was prescient and put some very specific language in their force majeure provision that arguably would have protected against a termination of that transaction. That's not to say a lot of deals, particularly in the private equity area, haven't been terminated. In fact, they're happening all the time. I happened to, before this call, take a quick look at PitchBook, and they have a story in there about the scrapping of the Forescout Advent International deal. Now, most of these are being based not so much on force majeure, but material adverse change. A materially adverse change is a broad concept, but generally speaking, most people have interpreted it to be a more longer lasting and enduring downside effect to the prospects for a business. And a lot of people have said, well, I don't know. It's too early to tell. Is COVID a long-term adverse effect on the prospects of the business? Well, the answer might depend on the type of business you're in. As we know, it has been horrific for hospitality and travel, but not so much for a lot of the telecommunications companies and the delivery services and other areas, which actually have seen significant upside to the crisis. So it can be really deal specific. That being said, I think anyone that is doing a deal today, at least on the legal side, and documenting it, it would behoove them to look hard at the language being proposed for either certainly a force majeure provision, but also their material adverse change language in their document to make sure that it results in the effect that they're looking for. If they want to redefine force majeure or material adverse change, well, first of all, the more specific you are, the better off you are. And if your biggest concern is pandemic, you want to see the word pandemic in your clause. That was the magic of the Davis Polk language in L Stores. They specifically highlighted the possibility of a pandemic. Why Kirkland and Ellis ever let that through is beyond me. But any case, it did get through, but oddly enough, I've been looking forward to the outcome of that litigation, which was being contemplated in the Delaware courts, except that each party decided to walk away and terminate the transaction without damages or liability to either side. And I think that might be the case for a lot of these deals because a lot of people don't really want to get involved in what is at best an uncertain litigation. And that could be damaging to the value of the company, if not to the potential acquirer. So I think that—
Rob, let me, because what you were just talking about, I want to go to John, because John looks for deals. And part of the issues that you're talking about, what I would call potential hurdles to deals that you're trying to document around. I want to know how John's dealing with that in his business for either acquisition or liquidation when you're ready to unload some portfolio companies.
Sure. Thanks, John. Happy to address that and to touch on some of the different things that Rob B mentioned as well in terms of, is it a material change and how long is the new normal going to really be the state of affairs? And so, what we have found is I would say, sort of two things. There are some industries, as Rob alluded to, that are much more stable in this environment than others are. So we have several businesses that are in the government services sector, and others that are in healthcare. For example, we have a business that provides recurring disease products to seniors at home. And so that one's been remarkably stable. Government services has been pretty good as well. So those are two sectors where we've been active, continuing to look for add-ons. We often buy platforms. Our pitch to our portfolio companies or potential portfolio companies is that we want to help them get bigger, faster, with less risk. And typically that involves a consolidation. So we'd like to find the right sectors for that. And then where it's a little bit more of a gray area, we are certainly comfortable using structure to get things done. And I think that's going to be more and more common in today's environment for the next couple of quarters, at least, where there's still a great deal of uncertainty. And, frankly, I think, Ricardo or others can comment on it, but the debt markets are certainly not going to be as open. Robert P. mentioned the price and then, the quantum, I think both of those things are affecting deals. And so I think where we will see deals get done is where the seller is still motivated for one reason or another and is willing to say, hey, I know there's some uncertainty, but I'm willing to get rewarded if things go the right way, upon the realization of my actual performance over the next 6 or 18 months, for example.
Go ahead, Ricardo.
And John, you kind of hit it right on the head. I mean, from our perspective, we're being very selective on what we do as new business. We're looking at the underlying assets. We're looking at the portfolio entities, what we're lending into, loan to values. What we were doing historically isn't what we're going to be doing going forward. And we're underwriting also the individuals as a lot more stringent. We're looking at pro formas, seeing how their particular industry is going to shake out. Now that we're 60, 90 days into this, we feel a little bit more comfortable to start looking at newer deals, where before we were really in a preservation mode and looking at the existing book and seeing how we're going to analyze and how we're going to, as an institution, survive, right? We want to make sure that we are there to help, but we obviously need to make sure that we're here and around to help people in the future as well. So for new loans, very selective, looking at the industries, looking at the individuals behind the industries, and relationship means a lot to a community bank. So single one-off transactions, very limited, if anything at all. I mean, they have to be a home run, priced right, low leverage, but we're really looking for those opportunities that we can capture new business that we feel has sustainability going forward.
Thanks, Ricardo. Paul, I want to ask you, back before the Great Recession, you used to hear Cov Light loans, right? I mean, that was the big thing. You had very few covenants in the loan documents. After the financial crisis, that changed. I guess that index that Rob P. was talking about sort of gets to measuring how loose the agreement is versus how tight it is, how protective or restrictive it is. And given the preference for lenders' selectivity and how John is discussing about their selectivity on the acquisition side, how are the loan documents out today, and what do you foresee in the next 6 months?
Well, I mean, I think it takes a pandemic for lenders and borrowers to revisit all aspects, John, of the loan documents. I think to a certain extent, the existing credits, we lenders, lawyers are kind of stuck with the structure that was negotiated when the deal closed. But of course, every aspect now has to be revisited, because the minute the borrower trips a financial covenant because its earnings are down, or because it just can't comply with the criteria because of the pandemic, I go back to my good faith scenario. The lender wants to work with its borrower. It wants to avoid the bankruptcy scenario that Jim was talking about. And I think lenders overall want to have the reputation of working with their customers and being open to situations where a credit is possible. In going to John's scenario, looking at new business as well as revisiting the old. So asset-based lenders are used to having covenants tied to earnings, tied to the ratio of the debt to net worth. I mean, that's not going to exit the industry, but if the credit is suffering, you're going to see lenders asking perhaps for a little bit more in the way of collateral, maybe restructuring how the document is setting up, looking at things like the importance of insurance. as a fail-safe for the client's business, and bringing in a consultant like Harvey Topis, who's one of our attendees today, and possibly just restructuring these obligations, maybe even bringing in guarantors when it wouldn't have had it in the structure before. So I think it just opens up to all kinds of opportunities to revisit all aspects of the document, to make it work, to make the customer exist, to allow it to survive, and to allow the credit to survive the pandemic, which hopefully goes away at some point.
Yeah, but Paul, what about new loans? What about originating new loan? What is that going to look like going forward?
Well, I mean, I do see some of the clients doing new loans. I do see the lender looking more scrupulously at some of the financials, taking a look at what kinds of covenants will work. I mean, the clients I represent are looking for the business, and it's just like in any other scenario, they're going to structure the deal so that the customer picks them. So there is a marketplace. Reasonable commercial standards do seem to level the playing field. I think depending on the kind of credit, you're going to continue to see covenants, but structured perhaps without all the add-ins to EBITDA that we saw during the golden years. But there has to still be some measuring stick to make the credit work.
So Jim, taking all of what you heard about the more selectivity that there's going to be for people that are borrowing money from people like City National, the loan documents going forward are going to be scrutinized more heavily, and you help some of your clients obtain finance, and you also have to deal with the existing finance and what's going forward. Tell me how you see business going forward, given all of this going on.
It's certainly interesting times, and I think one of the things we've seen with a lot of our clients and the various constituents they have, whether it's investors or lenders or frankly their partners, business partners, is really communications. They're spending a lot more time making sure that they're all communicating, which can be very helpful. More transparency. When dealing with their lenders and some of their partners, it's really projections and cash flows and things of that nature, just to make sure that they're getting through and they're planning for any kind of potential problems that could come up. And by planning for it, you can deal with it rather than, at this point, which is different than 90 days ago where people really didn't know what was going on. See, one of the big changes in what we're doing and, when we're doing M&A or capital raising is I think we've all learned, and we all knew it, but we probably didn't pay much attention to it, is that so much more could be done online. For example, this particular, thing that we're doing right now might have been in a hotel's ballroom if we had done this a while back, as opposed to doing it with Zoom and web. So technology's become very interesting from a due diligence standpoint. We all knew of we've been working with online data rooms for a long time, but we've even heard of people trying to do due diligence where they won't go out and visit a factory and they're using drones to try to do that kind of due diligence. So things are, people are getting more comfortable. We, as an example, went through an auction process where we were hired by a client a couple of months ago. We've never met the client. We ran a sale process, never met any of the buyers. We ran an auction, in that case, telephonically, never met any of the buyers. Went through, signed the deal, got it court approved, and closed the deal in, about a 60-day period, and never met any of the parties physically, which I can tell you would have never happened, but everybody felt comfortable with it. We all got comfortable in that particular situation. So I think there's a change there that will make doing business different going forward. When we get and talk, we can talk a little later on about valuations. That's the challenge that was just when John mentioned it, how you bridge the gap. And I, interestingly enough, just wrote an article for the Miami Herald about earnouts and the use of earnouts and other types of securities, because they're people are willing to pay a good price if things return to where they were. They may want the business anyway, but they're not going to overpay now on the promise that something's going to happen in a year from now. So it's interesting times and things are changing. And there just has to be a lot of flexibility. But when you get parties who want to do something together, there seems to be the ability to work through it with the lenders, with the equity partners, and with the principals.
All right, Tony. So you're not a bank. You deal with loans. You have borrowers, and you have borrowers probably now coming to you. How are you dealing with this?
Yeah, well, I think we're seeing behavior in our customer base unlike anything we've really seen before, and some of it is based on fear, honestly, because business owners are looking at their business, they're looking at their customers, they're reading the news, and they just don't know. I mean, they're not sure on the timing of the turnaround and when and how much volume is going to be picking up. So there's just a lot of fear, and I actually think that's good, because what's happening, what we're seeing is these business owners and these CEOs, they're doing a lot more modeling than they've ever done before. They're trying to figure out what the future looks like through analytics. And now they're taking more advice from their advisors. They're calling in their accountants more. They're calling in bankers, investment bankers. They're having more dialogue with their lawyers, because they're doing the modeling and they're looking at the details of their business, and they're saying to themselves, gee, we need to go see the lender because our covenants are going to blow up in 90 days. And maybe if we could put a plan in place that's outside the court, maybe we can get the lender to either grant us a waiver or some sort of a modification to the loan agreement. So we're seeing a lot more what I would call a proactive planning that really and truly should have been done all along. But I think with the virus, it's really opened some eyes, and it's putting in play a more analytic view of how the business is going to play out. Whether that means extended payment terms, looser loan covenants. Maybe they want to negotiate some sort of a term loan to term out some overadvances, or whatever the case may be. I think we're seeing people pay a lot more attention to the details now than they probably ever have.
Okay, so I want to take a break here for 1 second. I'm going to go to Rob P next, but for those who are on the webinar, there's a Q&A button there. If you want to ask any questions, put it in the Q&A. If we can't get to it, we're going to try to answer all the questions after the webinar, but we'll try to work in any questions that you might have. So you can hit that Q&A button and ask a question. All right, so Rob P. So you have the nervousness for borrowers that Tony was just talking about. You have the more circumscribed decision-making by lenders that Ricardo was talking about. John is talking about preserving deals, but making sure that the values are right, and looking to maybe have holdbacks or earnouts. And Jimmy's talking about pretty much the same thing, of making all of those components work together. What do you see as far as liquidity in the debt markets going forward to be able to handle these deals that are going to be coming down the line?
Yeah, thanks. And that leads right into it. I mean, liquidity, I don't think is an issue right now. I think the banks have money to lend. I think they're ready to lend. And by the way, I just want to go back to one thing. I completely agree. The RC draws that we saw in March and April, they're definitely getting put back to zero through high yield issuance and things like that. I mean, we saw hundreds of them in a month. RC draws, that's just public filers. And you're right. And then we've seen another 100 that they've announced they've repaid those RC borrowings. So I do agree with that. But anyway, so liquidity, I don't think is the issue from a bank standpoint or even an investor standpoint right now. What I am hearing, and I've heard this before from some of the panelists, is that most lenders on the bank side want a relationship. They want to do business with somebody they've already done business with, whether that's a due diligence issue or something else. To get a new bank to jump onto an existing syndicate or a new loan or a new bond I hear is becoming increasingly difficult. Again, I don't know if that's a due diligence issue or they're just trying to build a relationship, but if you were a lender before and they're coming into refi, those are the people who are going to jump in on the refi. To try and get a fifth guy to jump in on a 4-person arranger group, I'm hearing, again, I don't study this, I'm hearing is becoming increasingly difficult. But there is liquidity. Banks are willing to lend. And on the other side of it, the investor side, on the bond side, the high yield mutual funds are just taking in cash hand over fist. I mean, they're raking in. In fact, I just got a reading just before we jumped on the call. This week alone, they took in $6.3 billion of money through the mutual fund, and that's just money they're going to invest into more bonds. So the bond market certainly is clean. The loan side, we're still seeing outflows from loans. We're seeing some green shoots in the structured finance side, like CLOs. We saw a $600 million CLO, which is the largest in 4 months this week alone. We had 5 CLOs priced last week. So certainly there's some dry powder on the investor side. On the loan side, less so. On the bank side, tons. And on the bond side, yeah, they're ready to put their money to work. Back to the bank side, clearly in April, we were seeing 364-day facilities and really tight stuff. Now we're seeing 3-year, which normally last year would have been a 5-year deal. But now we're seeing some 3-year deals come up, no more 364s, but 3 years. And then hopefully it'll start opening up to 5-year deals. But yeah, I mean, so I see the market flush with cash. Again, my other panelists probably know better than me since they are transactors and I'm just an innocent bystander.
All right, so let's see, I'm going back to Jimmy. Given the liquidity that Rob was just talking about and the hope for the future, what do you see challenges, opportunities, third and fourth quarter?
So, there were some companies we were talking to prior to the time that COVID hit that wanted to go to market and had some fairly hefty or lofty valuation expectations. But actually, interestingly enough, you touch base with people to stay in touch and see how things are going. And I talked to a couple of them, and it was interesting. Their value expectations have changed. And part of it is their businesses have gone down. They were not part of the blessed group of healthcare providers or, grocery businesses, whatever. They think it's going to take them years to rebuild their business back to where it was. And they're of an age, early 60s in some cases, that they don't necessarily want to expend the time and energy to do that. So they're now talking about going to market, looking at, sort of third quarter, get through the summer. Everybody wants to wait and get through the summer, get into September, but get ready for it to go to market on these deals where their price expectations may be different than they were previously. And frankly, it was a surprise because they were pretty adamant about what they were looking for. So I think they're with family-owned businesses that wanted to go to market this year and it was time and some of them held off. Of course, in hindsight, they should have done something a year ago, but it is what it is. We're seeing some, the value expectations, start to change. I would agree with the group that there's plenty of money out there, but the banks aren't going to give it away. The private equity community is not going to overpay. They've done some of that in the past, but I think they'll be a lot more disciplined now to a large extent because they can be. And then, strategic buyers are going to start looking for opportunities to take advantage of, valuation that they can get, growth that they need, depending on whether they're public or private. But, I think there'll be good opportunity. And I would probably look at not so much the beginning of the third quarter, but into the middle of the third quarter, fourth quarter, provided we don't have a significant blip. Again, things don't go in the wrong direction where people sort of hunker down. It depends on, again, your belief whether even if we do have a second wave, whether things will get closed down or not. But, and they want, there's a little bit of a wait and see attitude to see our customer is going to come back, is buying going to come back, and how, those dynamics are going to play out. But I think we'll see not so much the beginning of third quarter, but middle third quarter, beginning of fourth quarter. I think we'll see things getting better. Now we're also with a very low watermark now, so things getting better. It's in a situation where you're the small guy amongst big guys. we'll see how that plays out.
So, John, sort of, we're talking about opportunities and challenges in third and fourth quarter. How are you approaching your business for those two periods?
Yeah, we agree with what Jim and Ricardo have really been saying, that I think where deals will get done is where it makes sense, and with the lending relationships where they are really looking to do more because of the dry powder that exists at banks, at private equity firms, at the different loan shops. Look, there's money that needs to get put to work, and the particular areas where we think there will be some traction and success will be add-ons. And so, the teams already know different companies in their industry often, and there's often enough synergies to justify a deal. So you're really not over-levering a business. If you can buy something at an attractive purchase price, have some synergies, and get the deal done. So we think that's going to be very, very common across our portfolio in particular. And then dividends are another option as well, where what we are hearing from some of our lenders is that they want to put money to work in situations that they know and that they're comfortable with. And so for a business that we might have had in our portfolio for a few years that has performed, and in fact performed well perhaps during the COVID crisis, then we think and are starting to see some appetite for dividend recaps, although I think that'll take probably a few months before those actually start to really clear the market. But I think add-ons, because of the synergies and the size, will be very common. And dividends. And otherwise, I think there won't be that much done in the lower middle market in particular. I think the perceived risk will be just too great for most folks. But we are already seeing activity in the more middle market and upper middle market where, the companies are just, generally, going to be bigger and less cyclical.
Okay. So, Rob Palmberg, what do you see third and fourth quarter?
Yeah, the only thing I do about predictions is do them wrong. So take everything I say with a grain of salt. Back to some of the points here, though. Yeah, definitely what I'm hearing from around the entire market is that most of what we're going to see coming forward, although I haven't heard the dividend story yet. That's why I laughed when you said that. I have not heard anybody talk about dividends just yet.
I'm just priming the pump. Just trying to...
I'm just saying, I haven't heard anybody talk about dividends. But I do hear a lot of people talking about platform companies acquiring smaller companies or acquiring companies to show returns, and yeah, a lot of large companies or middle market companies combining, and platform companies getting bigger through acquisition, and that's a lot of what I'm expecting to see in third and fourth quarter. And I'd love to see some dividends. It's hard to judge. I am horrible at predictions, and I could give you some statistics that we've gone through now. Clearly, defaults is going to be a big topic we're going to talk about over the next strong period. We've already seen multi-year highs in default rates just based on what's gone through in the last couple months. Remember, my market, the larger loan market, is all Cov Light, 90% Cov Light, 80% Cov Light. They're not even at the table yet. They haven't had to come to the table yet in a lot of ways, and we do predict that they're going to be coming. Whether that's a bigger default spike or recovery still remains to be seen, but we are expecting some defaults. In fact, right now, loan defaults are at 3.6%, which is the highest since April 2014, with bonds, because of Hertz recently, is at 4.9%, which is the highest since July 2016. We're predicting, obviously, certain sectors are just going to get crushed. Things like energy is having a really tough time. We're projecting like a 17% default rate in energy. Bonds, retail, obviously, could go as high as 15% default rates in loans and things like that. So we have some areas of concern going into the third and fourth quarter that we think defaults is where we're going to be focused a lot of our time on, especially most of the panelists on this table. And there's some leading indicators there. Downgrades from the rating agencies are up. We saw 400 downgrades over the last 2 months since February 21st. 401, that's 29% of the market's been downgraded, with 147 down to the most risky sector, or most risky rating, the CCC sector, and that's 11% of loan holdings. So we do see, and these are, again, larger loans, but it is certainly something we're looking at, and certainly more to come after July 15th, when second quarter earnings reports start coming out. As far as new issue volume, the calendar's thin right now. I mean, that's again, in the larger market, the calendar for loans is only at about $29 billion worth of M&A loans coming up. That compares to over 50 billion at the end of the year and 100 and something billion same period last, I'm sorry, not 100 and something, 60 some odd billion at the same period last year. So the calendar is still pretty thin. And again, back to the liquidity conversation, there's a lot going on. There's a lot of money to put to work. There's green shoots though. Certainly downgrades have come down. The secondary market's really popping right now. So we're seeing loans trading higher, bonds trading higher. So there is some cause for optimism, not my strong suit to be optimistic, but there's some cause for optimism. It'll just remain to be seen. And I do not think it'll be the middle of the third quarter. If I had to predict, I would say these are all fourth quarter events.
All right. Tony, how about you? What are you seeing?
Yeah, I pretty much agree with Rob on the turnaround. I think we're looking, best case early or late in the third quarter, but more likely at the beginning of the fourth quarter. We are expecting our clients to get busier. We're expecting to see volume increase. We're expecting to see, more pressure put on working capital assets to turn more quickly between now and then. I think our clients, for the most part, are looking for ways to preserve cash. There's going to be some defaults. There just are, and therefore I think there's going to be some consolidation opportunities that hopefully we'll get a chance to finance. And then finally for us, I think we are, as a business, we believe there's some opportunity for us on the acquisition side. We've acquired 6 businesses over the last 3 years. All of them have been either an asset-based lender or a factoring business. And we've currently got probably 3 or 4 things in right now that we're looking at, and we expect to see more. So in spite of all the negativity over the last 90 days or so, I think there's some good stuff. There's some positive things out there that are opportunistic for not only our clients, but for us as a lender as well.
All right, Ricardo, how about you?
So I'll take this question in 2 parts. I think overall we expect the third quarter to be slow. Hopefully it ramps up a little bit over the fourth quarter from a new business projection. We also are looking at the Main Street program that should be coming out relatively soon, hopefully with some guidance from the SBA once it's all approved. And we do believe that that's sort of going to be our third quarter focused, where we're going to help out business entities and see which ones qualify and fit the right mold through that Main Street lending. But in terms of just new captured business, it's going to be slow. I think that we have to digest the current portfolio that we have, make sure that it's in solid footing. I think all the panelists have agreed that banks and investment homes are much better capitalized than you would look historically. So from a perspective of, is there capital to lend? Yes. Is there hesitation to lend? Yes. Is there additional analysis that's going through the process, making sure we're making the right decisions? And that's really what we're focused on. So third quarter is going to be sort of getting our footing, see how this either sort of gets to the new normal, or we're looking at this as what the fourth quarter is going to look at and really start to be more aggressive in the fourth quarter.
All right. Rob Brighton, welcome back.
Yeah, hopefully you can see me. I'm kind of doing a cobbled together between my iPad and computer here version.
Well, you seem like you're there, and we can hear you. So, what are you anticipating for deal flow for third and fourth quarter?
Well, largely what I heard from the bankers and the private equity panelists on in our program. I think a lot of people will jump in opportunistically over the next 2 quarters, but in general, they'll be much more selective than they have been in the past. I think we're still not 100% clear what the fall is going to look like. We don't know if there'll be a second wave or not, for example. But I think most of us are anticipating a stronger fourth quarter in terms of deal flow. I don't know that people are going to sign up deals to the extent they did pre-COVID, at least until 2021. But I do think that it'll be a very uneven recovery in the sense that I think certain sectors will, benefit. One of the things that COVID has shown is that there are some areas that do well in a uncertain environment, in an environment where there are people who are hesitant to visit big block stores or take big vacations. There's other areas that have actually done very well in that area. And I also agree with the comment regarding, I think that bolt-on acquisitions are much more likely to get done than new areas starting out. I had a client, a very small business that only had about 10 million in revenues, that was just starting the due diligence process during the onset, just prior to the onset of the COVID crisis. The principals, believe it or not, had the unfortunate timing of going to Italy in early March, came back with cases of COVID, and that deal went into suspended animation. But the good news is they both recovered, and it looks like that deal's going to come back. So I'm told at the end of June, they're looking to finish up the due diligence and move forward with the goal of trying to get that closed before the end of the summer. So there's definitely a desire to do deals, but it's going to be more selective. I think different industries will be the targets, and we're not going to see anything close to a normalized deal environment for the rest of the year, I don't think.
So Paul, sort of the same question. What do you see as the with your clients, the deal flow and the legal hurdles that you foresee for third and fourth quarter?
Well, two things come to mind, John, and that is the interplay of all of these new debt programs that the government has set up, and how lenders interplay that existing debt relationship that it has with the customer, and whether or not the borrower is able to qualify for the PPP program or the Main Street program. I mean, in some cases, this debt is unsecured. It's there to support the customer, and I see the lenders working with their customers down the line to encourage them, within reason, to participate in these programs as we get through the crisis. I mean, historically, the lender would want to restrict its customer incurring additional obligations. There are negative covenants to that effect. And it'll be very interesting when the Main Street lending program is finally resolved, how that security interest is going to be resolved. Is it going to have to be superior? Is it going to be pari passu with the lender? And how will the existing lender react to that? Will it encourage its customer to take part in that or not? The other thing down the line is that I would like to add is we can't forget some of the other things that we were doing or going to do down the pike. One of the things that we lawyers have been looking at before the virus interfered with everything was we're going to be losing LIBOR in 2021. And there are countless loan agreements that calculate the interest based upon LIBOR. And I had been encouraging my clients to take a look at their existing loan documents to see what it said would happen when LIBOR expired. There are an awful lot of agreements that have an alternate measuring stick or give the lender the option to replace LIBOR with its replacement. SOFR is one that's being advocated now. Apparently, that's one that's been approved. It has to be integrated into the system. So my point is we can't forget the importance of dealing with all of the other aspects of the borrower and lender relationship, whether it's a bank asset-based or lender, or whether it's Tony, whose non-bank firm is busy doing new deals, and we see them and their affiliate in New York closing asset-based loans. So we have to reconcile the appetite for business, looking at the existing relationship, and not forgetting the other important things that we had to deal with independent of the virus.
Right,
This
so-
is Rob. Sorry, can I just ask this one quick question of John Fox? I'd be interested to know how many of your current portfolio companies or any of your target companies either get or you would think it a good thing for them to get any types of these government loan programs, because although I didn't get to this when I was talking about reps and warranties, I know that because of a lot of the reps and warranties and requirements within a lot of those provisions, there's a lot of uncertainty and in fact a lot of restrictions that come along with that debt.
Yeah, so it's a quick answer for us in that because of the affiliate rules, our portfolio companies are not eligible for most of the government assistance programs. I think some are able to take advantage of the deferral of some of the payroll taxes, but that gets repaid at the end of this December and then December of next year. But other than that, we're not really able to take advantage of anything else, from what I understand.
Well, target companies.
And sorry, what was the question about the target companies?
Is that a due diligence consideration when you're looking at target companies?
Yeah, 100%. 100%. That would be something that we would need to look at in terms of, is that a debt-like obligation, that is unusual. So certainly that's going to be part of our due diligence. We would 100% agree with you.
All right, so what I'd like to do is I have a few questions. I had one question that we didn't really touch on from a registered question. And this is from a guy who used to be a president of a manufacturer and is starting a new company. But for manufacturing firms affected by COVID-19, throughput and revenues are down, operating costs are up, and these manufacturers are having to hold higher inventories on their raw materials to mitigate the risks associated with harm to their supply chains. So he says the curves are crossing at different points. What's happening to valuations, and what are these between lenders, private equity companies, investment bankers? What do they do to prevent going out of business from these pressures in the opposite directions?
I'll jump
I open
in
it to the panel. Anyone can hit it.
Sure, I'll jump in with a couple observations. Going back to will deals really be getting done over the next few quarters? And I think one of our perspectives is that it's been a long bull market, for 11 or 12 years now, and COVID is here to stay. It's something where hopefully we're going to be quickly reopening the economy and things will be getting generally back to normal. Albeit it'll be a new normal. And I think as long as there is some recognition that those are sort of considerations and both sides of the table are open to that, deals will be getting done, because I think what we have found looking back to the last crisis in the mid 2000s is that these sorts of events make a lot of sellers realize that there is a good reason to sell a business, and that they don't need to hold out for that perfect valuation. As it relates to manufacturing companies and that realization, yeah, absolutely. We would look through those working capital dynamics. And one of the other things that we think is going to be positive for manufacturing companies, we do a lot of businesses that are industrial and are domestic, is the reshoring. There's been a big shakeup in the supply chain, obviously, and we think that there's going to be a lot of benefit to companies that are local, and hopefully that provides them an opportunity to gain some share. So some puts and takes with the disruption and the costs, but then some benefits as well. So we're eyes wide open to both of it on our end.
All right, Ricardo, same question, but from the lender's perspective, when you have those financial covenants and you see inventories are increasing, you see revenues going down. I mean, that's a bad sign for a lender, and how are lenders going to deal with it? I know you talked earlier about working with your borrowers to make sure that you preserve the relationship, but at some point, these divergent financial indicators are going to require the bank to do something, no?
Correct, absolutely. And so on my side, on the private banking side, we deal with less of the manufacturing business, but overall, how we're looking at it is work with them, first of all, on the deferment, work with them on the covenants, and see if there's anything that we can do either to prolong, if it's a payment of interest on a monthly basis as opposed to principal, and work with them as best as possible before we have to go to an ARD scenario, right? So if it's something that they are forecasting that it's going to be, 6 to 9 months and they're going to be able to get out of that, then that's great. We want to work with them through that time frame to make sure that we can support them. But if it's something that, an analysis clearly shows that it's not going to get better, we will work with them as much as we can. But obviously we have to make sure that we're doing what's right for the financial institution as well. One of the things that we're looking at in the way that the Main Street sort of rolls out now is that the underwriting is going to be based on 2019 financials. And so that is an avenue that we are going to direct clients to in this situation to say, hey, this is a loan that can provide some cash flow or some liquidity to you today. So hopefully it can help weather the storm in the long run. And I think that the way that plays out with 12 months of no interest payments, it's going to help out some of these businesses weather the storm.
If I might comment on that, it's interesting because obviously no two businesses are the same. They have to look at realistic projections, based on the trends and where things are going. And I think it's very important that they take a step back to understand that if they're wrong and they take down more loans, that's going to affect their equity value if they have to go through a sale process. And generally, when things are trending in the wrong way, and it may not be their fault, time is not your friend. So evaluating an opportunity to get out earlier, yes, the Main Street loan may give them cash, but if they burn through that cash over a year period, and the value is the exact same a year later, then whatever the loan is, any buyer is going to want to be paid back. So I think in working with and I think lenders are obviously much more realistic than an optimistic borrower who says, if I get the $5 million a year from now, things are going to be back the way they were. I think the best thing advisors can do, whether it's lawyers or accountants or the restructuring people, is making sure people are stress testing things, truly understand where things are going. And sometimes it's better to just make that decision now when you've still got some nice runway, you've got some liquidity, you've got opportunity, you've got a core business, than loading on another $5 or $10 million of debt under some of these programs and find out that as a result of that, what they thought was $15 million of equity is now $5 million of equity. And generally when you find the lower middle market sellers, they don't really look at what a business is worth. They do a backwards calculation. They try to figure out how much money they need to continue with their lifestyle, which is a model that does not work, but that's how they're looking at it. So they're going to get closer to it if they do something sooner rather than later, because they'll just dig themselves further into a hole. No fault of theirs in many cases, not bad business, bad decisions, may just be the unfortunate times we're in. But I think so it's important that, people, that the banks really but suggest or help or guide them to really looking at their projections and being honest with themselves and being optimistic, but being realistic and understanding, as I said, time is not your friend.
Tony, same question I had for Ricardo, and with Jim's insight there. How do you deal with those divergent trends?
Yeah, I think I would echo most of what Ricardo said. I mean, we're not opposed to having a conversation with the client about their business plan. We're going to look at all the metrics that go into their planning. We're going to look at their models, and we're going to try to come to some sort of a consensus on what's the best strategy. But if a plan is just being presented, I need to increase my inventory turns from 90 days to 180 days, and there's really no lift for benefit of doing that in terms of higher gross margins or higher revenues, or maybe cut some cost, then it's a pure economic decision. And while we are going to try to do our best to work with our customers, I think business owners have got to realize that they're the ones that have got to come up with a plan that they think can make work. And I also agree with Jimmy, you've got lifestyle issues at stake here as well. And sometimes that comes into play, and you just have to deal with it on a one-by-one basis and hope you can structure something that works for both people.
All right. So there are two questions in the Q&A slot. The first one is from Max Cohen. Do you guys see it on the panel? I'll read it so everyone can see it. It says, how are you seeing your publicly traded borrowers acting and the problems they are facing? Also, how is changing credit ratings affecting the loan docs you are seeing / deals closing? Who wants to hit that one?
On the first part, in terms of the publicly traded companies that may have some debt, look, we've seen a lot of interest over the years to where any middle market sized company is starting to really look and evaluate the risks and the rewards of being a publicly traded company. And I think we're seeing more and more of that right now. So we've spoken with several public companies where they've got interest in getting a pipe, whether that's for growth, for consolidation, or because they've got very conservative lenders. And so I think that trend towards their, really being more take privates is going to continue.
What about on the lending side? Anyone want to hit that? Paul?
Well, I would just say that the credit rating is going to be, John, one of the many factors that a lender is going to take into consideration. I think there's just an awful lot going on now, and that's just going to be one of many. We've talked about all of it, and it has to do ultimately with what the panelists have said, the communication, the reporting, the reality check is all going to be viewed. The collateral, what is it worth? How do we measure it? And our willingness to be more flexible in how we verify information going forward. It's a new norm, as we've all said, and how we used to do business is a little different now. And if we want to do new deals, we have to be creative. And our panelists, John, our experts here have given us some very good examples of that.
Thank you. Let's move on to the last question. And this comes from John with an H. There are two Johns that go without an H here. Does the panel see a shift in the middle market to non-asset-based lenders and factors going forward? Ricardo, that one is, I'm going to throw to you first because that's actually a question where they're asking, do you see people moving away for asset-based loans, moving away from traditional banks?
So I see in the short term, I do believe that that's something that people are going to start to look at as banks are more tentative to put out these middle market loans. And then as we go into the fourth quarter, if things from a pandemic perspective stabilize, I think that you'll see the banks sort of tipping their toe back into it and see how it stabilizes. But in the short term, I do see that shift. I think the banks are just a lot more tentative.
What about you? What do you think?
Yeah, I couldn't have said it any better. I agree with everything Ricardo said. I think that for the next 60, 90, 120 days, you're going to see a little bit of a migration away from the bank groups and more into the non-regulated side of things. And then I also believe that in the first quarter next year, we get through this, depending on the metrics on coronavirus. At that point, banks will start dipping their toe back in it. So I agree with everything Ricardo said about that.
Okay, Jimmy?
It's interesting. I mean, it's typical as companies start running into covenant violations and the banks, do their evaluation and determine that the risk reward based on the rates they're changing isn't sufficient. It then moves. You could view it either upstream or downstream, depending on how you view the non-bank lenders, which generally have a different set of covenants. They're looking at things a little differently. And frankly, their pricing is different. They also don't have the same kind of requirements the banks have in dealing with regulators and reserves and things of that nature. So I think first you'll see, where the banks can help the right borrowers with some of these new programs. First it was PPP, now it'll be mainstream. There'll be borrowers that they have that they'll suggest in a very nice way. It's probably a good thing for you to find a home now while you can. And, people will do that. And then, as it was mentioned, and I certainly concur with others on the call, that, if things stabilize, they'll want to come back to the banks and the banks will want them back at that point, but with a little more stabilization.
John, did you want to be heard on this?
We would agree with everything that Tony and Ricardo and Jim have said, and just really relate it back to the last cycle from 10-ish years ago when we saw the exact same behavior, and there were banks that were popping up that didn't have to deal with legacy loans, and we're out there sort of seeding new territory. And look, I think our takeaway from back then was really the only deals that we regret from that time period are the ones that we didn't do. So, we generally think for most folks, it's going to be a good time to be active over the next few quarters.
All right. Anyone else want to be heard on this question? All right. Yeah, go ahead, Rob.
Real quick. I think that the movement away from commercial banks is probably at best a short-term thing, because I think a lot of things that people who have had existing relationships with banks have found is they're their best source for sympathy and understanding when they have bumps in their results. They're the people that were probably most willing to give them that PPP loan versus some new lender. Particularly asset-based lenders that are funded through hedge funds and other high-cost capital vehicles tend to have a higher cost structure. And most of those people are usually, they're necessary to the process. I don't want to downplay their importance, but I will say that most people would like to have a commercial banker that they're comfortable with that as part of a long-term relationship.
All right, well, that's the last question. We finished on time. I want to thank the panelists for devoting this afternoon to help us put on this material. I hope the attendees found it useful. I know I found it useful, and we are, oh, there. So there's everyone that was on the panel. If you have any particular questions, you can email any one of them. If you have anything you want to follow up with for the attendees, by all means, reach out to us. We'll be happy to address anything you may need. Thank you, everyone, and have a good afternoon.